Most hoteliers budget for the following year using the best information that they have at the time. It's hard work and the team puts their heads together to do the very best they can. Still though, it's a shot in the dark at best. There just isn't a crystal ball. So what do you do when your budget just isn't helping? Well, this week we're talking about forecasting. A forecast is simply making a copy of your yearly hotel budget and adjusting for new information when you're getting closer to the actual dates. If you're creating next year's budget in October, for example, it'll be challenging to estimate what your sales will be next June. However, next April, you'll have a much better idea of what June will look like, and that is where your forecast comes in. The budget, once finalized, shouldn't be altered. You can, however, use it as a baseline to create a more realistic hotel forecast. Many hotel pros who say they forecast really mean that they get their updated 30, 60, 90 revenue forecast, but they don't go the step further to adjust their expenses. That revenue forecast is gold. It just doesn't quite paint the whole picture. For instance, your income statement may show that comp breakfast cost is 10% under budget. Awesome. But if revenue is down 30%, that cost should actually be much lower. And vice versa. The income statement may show that comp breakfast is being over budget. But if revenue is up 30%, then there's a very good reason for that. Your forecast adjusts those expenses so that you can see the full picture. When the hotel budget becomes unreliable, it can get written off, leaving the team feeling aimless. Your forecast, on the other hand, is much more real time, and if the team sees revenue is going to be less than expected, they can act quickly to cut any fixed expenses that aren't really necessary, to make staffing adjustments, to make more informed purchasing decisions, and possibly to prepare the hotel owners if a cash call might be needed. It's exceptionally normal for hotel pros to make their operational budget for the following year, but just never get around to doing monthly forecasts. So if that's you, you're in good company. If you want to give forecasting a real chance though, you need to implement a simple forecasting process that you do every month. Here's an example of what that process might look like. Building the forecast is going to take the combined efforts of your operations and hotel accounting team, probably the same players that produce the budget. Step 1, make a copy of your budget spreadsheet. Let's say it's January and we're updating the forecast for February, March, and April. The general manager or whoever is appropriate on your team can do this. Step 2, the sales or operations team determine the estimated occupancy percentage and average daily rate for February, March, and April. If you're a branded hotel, the franchise likely has software that helps you determine these numbers, like GRO for Hilton and One Yield for Marriott. You set your own deadlines, but let's say they need to do this by January 15th. So step 3, change the ADR and occupancy percentage numbers at the top of the February, March, and April columns so that all the formulas that you created on your variable expenses in that budget spreadsheet will update. Step 4, update any known changes to fixed expenses and save this as the February forecast. Step 5, you can use the information in this spreadsheet as is, but it's even more helpful if you can import it into your accounting system. If you're using a robust hotel-specific software like M3 or Hotel Investor apps, it can be imported very similarly to how you imported your budget. And step 6, if you import this into your accounting software, you can now run your financials with a forecast column and glean new insights about what's coming up for your hotel. All right, thanks for watching. Have a great day.